Here we go, guys. I'm Q, the PV CFO. Today, what I want to talk to you about what I call deferrals. Deferrals is somewhat like when you pay for something in advance and you haven't really used it up yet. So a prepaid can be like a prepaid insurance, prepaid rent, right? Or even like when supplies are bought in advance. So something that's prepaid is like, an asset, of course, because you pretty much put the money out, send the cash, but you're going to debit your asset because it has some new stuff in it. So I'm going to give you a couple examples of how you do investment entry around the first associated with prepaid type of activity. So on this case, what I got to show you guys here, I have the assets use liabilities formula. I'm going to identify the accounts and the assets. I'm going to identify my expenses on the expense portion of the stockholders' equity, right? So let's say, for instance, if we had a rent item, and we're talking about on January 1st, these transactions happen. January 1st, but we're going to close the books for January 31st, right? So we prepaid rent for $5,000. I debited my prepaid rent account because prepaid, and then I credit my cash account and reduce cash by credit. And then I have an insurance policy to be bought for 12 months. Of course, the insurance policy covers a time frame of 12 months, so I can't expense everything. So, but at January 1st, I bought it for prepaid amount of 12 grand. So it's going to be like $1,000 a month, right? So I debit my prepaid account for 12,000. I credit my cash, all right? So now, and then I also want to stock up my company with supplies. So these supplies, I want to debit supplies and credit my cash for $7,000, right? So what I've pretty much done is now started like putting some deferrals in my asset accounts. Now, if I close my books in January 31st, below here, so I'm going to show you how you got to do some entries. Because right now, if I close my books without doing some accruals or some adjustment entries, or however we want to do our deferral adjustments, my prepaid rent on my assets is going to be overstated. My prepaid insurance on my asset side is going to be overstated. And my supplies are going to be overstated. So let's start with prepaid rent. So by the time January 31st comes around, we have already used that spot. We've already been in that place renting it out for 30 days. So we have to exhaust that prepaid. So what I would do then is to get rid of the prepaid for that month, I would have to do what? Credit prepaid for $5,000. Now I can expense it. Think about expenses when you talk about prepaids, type of deferrals. Then I got expenses. So on this side, I'm going to expenses to the rent account. $5,000. Still in balance, right? Then my prepaid insurance. Prepaid insurance is 12 months. So $12,000 divided by 12 months, $1,000 a month. We're at January 31st cutoff. Got 1 month of exhausted costs for prepaid insurance. What do? Like I said earlier, prepaid is overstated. I got to reduce it. How do you reduce a prepaid, which is an asset? You got to credit it. I'm going to credit my prepaid account for 1 month. It's going to be $1,000. Now I got to exhaust it. That's expense account. Third, now I have supplies. So let's say supplies, right now at the end of the month, has a balance. We originally started, had a balance of $7,000. Now we're saying supplies has gone from $7,000 to like $6,000. So we must have used $1,000 of the supplies account. So how do you exhaust the supplies account? You have to reduce it. As I said, an asset, you have to reduce it with the credit. So what would you do? You would credit the asset account. $1,000. Now you have to expense it to the P&L. Debit supplies, $1,000. We're still in balance. See? So now what we've done, now the assets are not overstated anymore because we reduced it by 5. The prepaids aren't overstated anymore because we reduced it by 1,000. The supplies account isn't overstated anymore because we reduced it by 1,000. Now your P&L is not in terms of expenses, it's not understated because you reflected the actual expense in the month of January. Okay, so if you did a net income, revenue minus income, your income would have been overstated. So, I just want you to know that. So as I said, the assets are no longer overstated and the expenses are no longer understated. And your net income, had you not done that, would have been overstated because you didn't reflect expenses that should have brought your net income down. So on your test, you're going to have questions like, oh, prior to adjusting entries for deferral type of a transaction, which is like prepaids, if they weren't booked, is assets overstated? Of course they were. Is expenses overstated? No, it's understated. But your net income would have been higher, which means it would have been overstated because revenue minus expenses is net income. So your net income would have been too much because it didn't reflect an expense to bring it down. But now, we booked the expenses. Now your net income is in line with the cost, periodic cost that was incurred for that period. And your assets are now in line with the cost of the adjusting entry to bring the assets down into play for January 31st. There we go, guys. That's an example of how we treat prepaid deferrals and adjusting entries to get to an adjusted trial balance. To make sure now you understand, I'm just using my T accounts to kind of give you a flow of how things should work. All right? Last question that may happen on your test, you might say, okay, what is my prepaid account balance at January? So if you did that, we know our prepaid account had $5,000 for rent already. Now it's zero. We know our prepaid insurance at the beginning had $12,000. Minus 1,000, now it's 11. We know our supplies account, when we supplied our office with supplies, had a balance of 7 at January, 7,000. Over here. Now, debit and credit, we got a balance of $6,000. So your balance at January 31st is 0 for prepaid, 11,000 for prepaid insurance, and 6,000 for supplies. Hope that makes sense. Stick to your T accounts, understand the flow of transactions, book them to debits where they need to be, do your adjusting entries, get your rolling balance. All right, until then, guys, I'm going to talk about unearned liability, and we're going to see how that works in our deferral analysis for adjusting entries. I'm Q, the People CFO.